When you think about the biggest threat to your financial success, you probably think of a market crash, right? Well, what if the real danger is your own brain? That's the huge lesson from one of the most important investing books ever, Benjamin Graham's The Intelligent Investor. So over the next few minutes, we're going to break down his classic framework for taming your emotions and actually succeeding in the crazy world of finance.
All right, so first, let's set the stage. The thing Graham really understood is that Wall Street, well, it often runs less on cold hard facts and more on pure contagious emotion. It's a place where mass hysteria can just take over, sweeping up absolutely everyone in its path. And I mean everyone, including, as we're about to see, one of the most brilliant minds in all of human history.
So check this out. This is a pretty humbling confession from Sir Isaac Newton. And yes, I'm talking about that Isaac Newton, the guy who literally figured out gravity and calculated how the planets move. He could map the entire cosmos, but he couldn't get his head around the sheer irrationality of a financial bubble. And oh boy, did he learn that lesson the hard way.
And that right there, that was the price tag on his lesson in market psychology. See, after making a really nice profit on something called the South Sea Bubble, he got totally swept up in the mania. He jumped back in right at the peak and lost $20,000. Now, that doesn't sound like much, but in today's money, that's over $3 million. It's the ultimate proof of Graham's point. Being a genius doesn't mean a thing against market madness if you don't have the right emotional discipline.
And look, if you think this is just some weird thing from ancient history, think again. Just look at the dot-com bubble. In 1999, these tech stocks delivered an unbelievable 1,200% average return. Can you even imagine? But what goes up on pure hype has to come crashing down. The years that followed were an absolute bloodbath. Losses of 79%, then another 35%, then another 44%, completely wiping out every single penny of those gains and then some. It's a perfect modern example of Graham's timeless warning: on Wall Street, unchecked enthusiasm is pretty much a one-way ticket to disaster.
So how in the world do you survive this madness? Well, Graham's answer is actually pretty simple. He says the most important battle you're ever going to fight isn't with the market, it's with yourself. It all comes down to a really fundamental choice you have to make. Are you an investor or are you a speculator?
And the difference between the two, it's like night and day. The speculator, they're just obsessed with the stock's price. They're glued to the ticker, trying to guess what it's going to do next based on rumors and hype. The investor, though, they totally ignore all that noise. They're focused on the business itself, doing the hard work to figure out what it's actually worth, no matter what its price is doing day to day.
And Graham, he draws a really hard line in the sand with this definition. For him, an investment isn't some gamble or a hot tip. No way. It's an operation that has to meet two super strict criteria. One, it's backed by deep, thorough analysis. And two, it promises to keep your original money safe while giving you a decent return. If it doesn't meet that standard, it's not investing. It is pure speculation. Period.
Okay, so to help us stay rational in all this chaos, Graham came up with this brilliant mental model. It's this amazing little story that basically personifies the market's wild mood swings. So think of it this way. You're about to meet your new business partner.
I want you to imagine for a second. What if the entire stock market wasn't this big, faceless entity, but it was actually a single person? And this person is your co-owner in every single stock you hold. His name is Mr. Market, and he has let's just say, a very unique personality.
So here's the thing about your partner, Mr. Market. He's a manic depressive. Every single day, without fail, he shows up at your door, just shouting prices at you. Some days, he's totally euphoric, convinced every company is the next big thing, and he'll offer you ridiculously high prices for your shares. But then other days, he's completely gripped by despair, convinced the world is ending, and he'll offer to sell you his shares in fantastic businesses for pennies on the dollar.
And here's the beautiful part of this whole thing. You hold all the power. You are completely free to just slam the door in his face every single day. You don't have to listen to his euphoric ramblings, and you don't have to listen to his panicked cries. The only time you engage with him is on your terms, when the price he's offering actually makes sense based on your calm, rational analysis of the business.
Graham's insight here is just so profound. That daily stock quote you see, it's not a command, it's just an offer. And once you realize you don't have to let Mr. Market's moods dictate your own, you completely flip the script. You turn him from your master into your servant. You start using his emotional fits to your advantage, buying when he's terrified and selling when he's greedy.
All right, this leads us to Graham's second huge idea, and honestly, maybe his most important one of all. This is your ultimate defense against bad luck, against your own mistakes, and against the simple fact that we can't know the future. It's called the margin of safety.
At its core, the margin of safety is really just common sense. Never, ever overpay. It's all about figuring out what a business is truly worth and then buying its stock for a whole lot less than that. You can think of it like an engineer building a bridge. They need it to hold 30 tons, so they design it to handle 60. That extra room, that gap, that's your buffer. That's your cushion against bad luck, miscalculations, and a future you just can't predict.
So here's how it works in the real world. Let's say your analysis shows a business is worth about $1 per share. Well, you don't pay $1. Nope. You patiently wait for Mr. Market to have one of his bad days and offer it to you for, say, 67 cents. That 33-cent gap between what it's worth and what you paid, that is your margin of safety.
And believe me, this isn't just a theory. Take the Washington Post Company way back in 1973. Mr. Market was so depressed that he was willing to sell you the entire company, the whole thing, for just $80 million. But if you actually did your homework and looked at the assets, the newspaper, Newsweek, the TV stations, they were worth at least $400 million. Buying at that price was like getting $5 worth of incredible assets for just a single buck. Now that is a massive margin of safety.
And this is maybe the most important takeaway about this whole idea. The margin of safety isn't about being a fortune teller. It's the exact opposite. It's you admitting that you can't predict the future. It's the built-in protection that makes sure that even if you're wrong, if your analysis is a little off or the business hits a rough patch, you're not going to suffer a catastrophic loss.
So when you put all these pieces together, distinguishing yourself from a speculator, learning to treat the market as your servant, and always demanding a margin of safety, what you get is this powerful, rational framework for success.
So here they are, the pillars of this whole philosophy. First, a stock is not a lottery ticket. It's a piece of a real business. Second, Mr. Market is there to serve you, not to guide you. Use his crazy moods to your advantage. Third, always buy with a margin of safety. And finally, number 4, your temperament, your ability to control your emotions, is way more important than your IQ. I mean, just ask Sir Isaac Newton, right?
But the big question is, does this stuff actually work in the real world? Well, the proof is pretty undeniable. Warren Buffett famously wrote about the super investors of Graham and Doddsville, this group of people who all learned directly from Graham. Now, they all went their separate ways, they used their own methods, but they all stuck to these core principles. And the result? Every single one of them independently achieved spectacular, market-crushing returns for decades. It's the ultimate proof that this isn't luck, it's a timeless, repeatable framework.
So that leaves us with one final, really essential question we all need to ask ourselves. When you buy a stock, are you just reacting to price movements and market chatter, or are you calmly analyzing a business and buying it for less than it's really worth? To put it simply, are you investing or are you speculating? Answering that question honestly is the very first step to becoming an intelligent investor.